I still believe over the next 5+ years, stocks will deliver an equity risk premium due to increased productivity, in particular due to AI.
Hi, everyone. I'm Gunjan Banerji.
And I'm Telis Demos. Welcome to another episode of WSJ's Take On the Week. And this week, we're talking about the market. I know we always are talking about the market, but we're really talking about the market this week because it's really reached a fever pitch. The question being, are we in a speculative bubble? We had a really interesting statistic the other day, which is that margin debt, right? Which is basically what people are borrowing in brokerages to place bets on the market, to buy stocks and other securities. And that
to turbocharge their bets, right?
Exactly.
They really want to magnify their exposure to the markets.
You borrow money so that you can buy more. And that debt hit an all-time high of over $1 trillion for the first time, according to statistics from FINRA, which tracks this. And that's really a sign that investors are really quite bullish.
To your point about margin debt, though, that really is seen as a sign of exuberance out there to a lot of investors. And it's not the only one. Take a look at Robinhood earnings. That has become just the poster child of speculation out there.
Yeah, they were a blowout, right? I mean, they were
a total
really strong.
blowout. I mean, their stock has surged this year, and their recent earnings showed that trading in equities and options hit all-time highs. So surpassing anything that we've seen the past few years, which is pretty remarkable.
Yeah, so for Robinhood, that means above the levels they were back during the 2021 meme stock mania, right?
Yeah, I mean, just the share of individuals, as we've talked about before, the share of individuals and things like options is above levels seen during the GameStop mania. I was looking at some other data. We think of, these periods of exuberance as associated with this rush into bullish bets. And call options volumes, trades that typically profit when stocks go up, they have been elevated, but they've been particularly extreme in volatile and unprofitable stocks.
Well, there's one report coming up next week that I think from the point of view you were talking about, Gunjan, the real kind of speculative fervor type thing, and that's a company called Palantir.
Palantir stock has surged more than 100% this year, and it has just exploded over the past 12 months. And a lot of investors, interestingly, still kind of consider it a meme stock because it has this really avid retail following. For example, some of these investors call its eccentric leader Daddy Carp. But now, I think showing the power of these investors, it's now one of the largest companies in the U.S., and its earnings are due in the next few days.
Well, I think that's going to be super interesting to watch. And that's why I'm really excited about that we had this week with Sebastian Page, who is the head of global multi-asset at Rowe Price, also the chief investment officer there. Rowe Price, obviously a giant global asset manager. Look, I know we've highlighted a bunch of frothy sounding things right now, but there are a number of things that people look at, to say whether or not the market is truly in a speculative bubble. And we went through a lot of these with Sebastian, and not all of them were necessarily pointing towards bubble, right?
A lot of the companies that are powering the market higher are actually making a lot of money. Yeah. They have a ton of profits. Think about these giant tech companies, and we saw that over the past week.
Well, we got into all that and a lot more with Sebastian Page, including all the signs, yes and no. Are we in a speculative bubble? And we're going to have that conversation after the break.
So tell us, I feel like we're hearing the bubble word a lot recently.
Yeah. The journal's coverage of the market is getting pretty fizzy lately. Seen some things looking at what's happening in meme stocks.
Meme stocks are back.
Crypto. And just the valuations of the stock market. People are asking the question.
It's starting to feel a little crazy. And Sebastian, I'm curious what you think. Do you think that we are in a bubble right now?
Well, Gunjan, we're starting with a strong question right here. We just talked about the B word, bubble, in our asset allocation committee. If you look historically, when you've had such market concentration, it usually preceded bubbles. However, to me, the fundamentals are there. We're talking about an index that's concentrated, but concentrated in companies with awesome margins, awesome profits, cash flow generation,
the
so
tech
on.
companies, the technology behemoths,
like
right?
how NVIDIA is a huge percentage of the S&P 500, right?
Yep,
Okay.
and makes gobs and gobs of money.
Makes a lot of money.
Yes.
People like to use the word froth.
Right.
That is a sign that we might be in the run-up. And then you get into the scarier ones. The Goldman Sachs Speculative Trading Index is at an all-time high.
Okay.
They look at trading volume in high-risk, low-quality stocks, in meme stocks, and they just look at the trading intensity in those types of securities. I think, the one that worries us the most is the performance of high-risk, low-quality stocks last quarter relative to high-quality stocks. We're talking about ranges of like 10 to 20% outperformance from low quality, high beta, high risk stocks. That is also bubblish.
So just to play devil's advocate a little bit, I feel like I've been hearing about market concentration for years, and stocks have kept going up. I feel like I've been hearing about high valuations for years. Stocks have kept going up.
Well, and just to point out, you mentioned the Goldman Sachs, that speculative index. Our colleague Spencer Jacob the other day mentioned it in his column, and he said that the part two of that thought is that usually precedes outperformance of above average S&P 500 returns over the next 3, 6, and 12 months, right? We read the same statistic. But so, that could be a reason to buy, not a reason to sell.
So ultimately, we're neutral between stocks and bonds in our asset allocation committee right now. We see these signs, but I completely agree with you. Like, we talk about high valuations as if it's a short-term signal of impending market doom. It's not. And the best way to convince yourself that we have to live in a higher valuation world, look at the net profit margin chart on the S&P 500 for the last 30 years. It's near an all-time high, and it's been trending up consistently. And I'll play devil's advocate with you. The fundamentals are actually pretty good. Growth expectations for GDP cratered following the tariffs headlines. I think they overreacted in terms of economics projections, and they're probably due to stabilize and normalize back up. And then you have fiscal spending. We believe the big, beautiful bill is stimulative. Yes, we're renewing certain tax cuts, but at the same time, we're lowering, not eliminating fully, but lowering taxes on tips, Social Security, and overtime, and we're allowing 100% depreciation of CapEx, which encourages companies to invest because they can depreciate all those investments.
The bottom line on that would be just that, companies are permanently more profitable if corporate taxes come down. But let's ask about the other big thing going on in the economy, which is tariffs, obviously. Does that count if companies are, which it seems like so far they have been, absorbing some of the tariffs, keeping it out of the inflation data to an extent, is that going to counteract that profitability? I mean, I know tariffs are kind of a one-time event, but if they stick around for several years, is that a reason you might want to take a couple of points off of the market's valuation? Just A, because of the profit impact, and B, just the uncertainty of what that will mean. Shouldn't people be cautious right now because of that?
Telis, I'll give you a nuanced answer. Tariffs
I like those.
matter for economic growth, but they don't drive the entire economy of the U.S. And I think you had Austin Goolsbee say that on your podcast recently.
We did, yeah. He was more optimistic, I think, than you might have expected him to be.
Yeah.
So it's not the entire economy. In fact, services consumption is 45% of GDP, and it drives 70%, 70, of GDP growth. So the market is starting to behave that way, as if, tariffs no longer the entire outcome for S&P earnings and for the economy. They certainly drive a lot of headlines, and I don't want to minimize them, and it will be inflationary in one way or the other, maybe shorter term, maybe a little bit longer term as well. Our economists are concluding tariffs will be inflationary. We just had a 15% tariff on all goods imported from Europe. You saw it in the last print, by the way. If you look at all the categories that jumped by 0.4% month over month or more, these are all things you buy on Amazon, cheap things you buy on Amazon, like garments, or not so cheap, but like appliances or small toys or things that you get shipped from overseas and you click and it's cheap. A lot of these categories went up by 1% month over month. So you're starting to see the impact of the tariffs.
So what are the key things you're watching right now if tariffs are not the entire picture?
from a positive perspective, Fed fund rates coming down with earnings going up and all those positive fundamentals like fiscal spending, like the stabilization of the tariff discussion, the consumer strength. And if you think of consumers and spending, retail sales are expected to grow about 4% year over year. That matters a lot, especially on services. Unemployment is quite low at an aggregate level. And then consumer balance sheets are quite good. Net worth is at an all-time high, and debt service ratio is in the bottom 20% of its historical range.
I just want to take a pause on that for
Tell
a second.
us as the pro on this corner.
I just wrote about this, and a concern about that is that is absolutely true. The consumer's in a great place. So if you serve up a rate cut to those consumers, I know you said nothing's going to pop right now, but aren't you sort of pumping more air into the bubble with that rate cut, at least from the consumer's point of view?
In theory, yes, but to play the contrarian once again, I don't think a couple rate cuts matter that much. In fact, we just had like 100 basis points of cuts, and the 10-year yield went up, not down, up by 100 basis points. So I don't think the Fed drives the entire economy with these 0, 1, or 2 cuts.
Clearly not, based on where we are right now, right? And how the economy has held up.
And as you pointed out, Sebastian, the market has rallied through the hike. It rallied towards the end of the hiking cycle and has sort of not seemed to view the Fed rates as a constraint, right?
I mean, look, Telis. So the sensitivity of the economy to 50 basis points of cuts over the next 6 to 12 months is probably greatly exaggerated, a little bit like the tariff discussion, like the entire economy moves with tariffs. And the long end matters much, if not more, than the Fed funds. So if the curve steepens and the 10-year yield goes up, that is actually restrictive.
Okay, so I want to focus on a bubble factor that you didn't talk about, and that's the equity risk premium. The equity risk premium is basically the yield you expect from stocks versus the yield you would get on bonds. And so because of that rising 10-year Treasury yield, and because stocks have gotten so much more expensive, those two things are way more equal than they normally are. And for a lot of people, that's the sign of a potential bubble, that you should be paid a lot more to own stocks effectively than you should bonds. Stocks have risk that bonds don't. So what does it mean to you to see that, and what should investors be thinking about the stock versus bond parts of their portfolio?
You're right, Telis. It's almost the same. And you know what the cool thing about bonds? The returns are quite predictable for bonds, especially if you take a 4, 5, 6-year horizon. The yield is a very good predictor of the actual return you'll experience. It's much easier to forecast bond returns than stocks returns. Stocks, it's a question. I still believe over the next 5+ years, stocks will deliver an equity risk premium due to increased productivity, in particular due to AI. It's no joke. I talk to our analysts, our portfolio managers. We love to research technology at T. Rowe Price. It's one of our areas of expertise. They all say the same thing, and I haven't heard that for all new technology trends. They all say it's real. And we're starting to see it in our own lives. If you start using some of the top tools and pushing them a little bit, you can see in action the productivity that we'll get. So there's earnings power, some high margins. And I do think that over time, you'll continue to get a risk premium for stocks. Yeah, maybe it'll be a bit more compressed than historically. Now, I don't think that was your question, Telis. I think you were more asking, is it a signal of a bubble, right? Is it sort of a short-term negative signal?
Well, one way for them to come into balance is for stocks to sell off, right?
Yes, and it also explains why there's so much cash that hasn't been deployed, $7 trillion in money markets and checking account. If you can get the 4.5% on the short-term government bond fund, it's kind of very low risk, so it's hard to convince yourself to move it to the stock market. So it speaks to the fact that bonds are a much better alternative to stocks. But over time, there's a reason why you should get an equity risk premium. And if you want your wealth to compound and you have a long time horizon and you're willing to accept short-term losses, in my view, you should have a healthy allocation to stocks.
So if you're a retirement investor, stick with your stocks is what you're saying.
So Sebastian, you recently wrote this book, The Psychology of Leadership, and have talked a lot about what investors can learn from sports psychology. And it seems like right now, this group of stocks in the market kind of has a hot hand. How do you navigate that?
I think sports psychology is greatly underrated in general for self-improvement, but in particular for investing. Because if you think about athletes, they have to deal with a lot of uncertainty. They can prepare as much as they can, but they can face bad weather, a ref that's not fair. They can't control what their opponents are going to get. So those that are process-oriented in sports psychology, it's demonstrated that they're able to differentiate between luck and skill. And we're just talking about speculation. When there's a lot of speculation, investors forget to differentiate between luck and skill. I can make a really bad decision. I could go out to dinner and drink too much wine and drive. And if I get home safely, it's a good outcome, but it was a horrible decision. Or if I use Uber, but Uber gets in a crash, it's a bad outcome, but it was a very good decision. So the mindset of separating outcomes from the quality of the decisions you make is really difficult, but really important for investors. That's why I'm glad you asked the question, Gunjan, because probably maybe in our audience now, there's a lot of people making a lot of money right now in markets. But think about whether it's luck or skill.
Given all of this speculation right now, how are you positioning?
So we are, in a nutshell, neutral between stocks and bonds, because I talked about signs that we might be in the run-up to a bubble, but I also talked about very strong fundamentals, stronger than most people think. So we like to sit at neutral. We're long diversification. So the portfolio is less concentrated. For example, we have an overweight position to international value and small caps. And we are short duration, meaning we have less interest rate sensitivity. We have less treasuries, long treasuries in the portfolio than we would normally have. Neutral stocks and bonds, long diversification, for example, international, and short duration. We have a view, and it's not just tariffs, that there are upside risks to inflation, whether it's the pace at which wages are growing, a housing shortage in the country, the risk that commodities could pop anytime. Add to that tariffs, there are some upside risks. Add to that deficits, which can put upward pressure on the 10-year, and you get the picture for why we're underweight duration. We have more cash in our bond portfolio than long bonds, and we also have more credit than long treasury bonds.
So to the point you were making about process versus outcome, is that a portfolio that might sometimes kind of not feel like it's working because your returns are lagging the market, but you should stick with it because it's got like a sound process? I'm just wondering, is that the way that you need to approach a market like this? Like, stick with my process, even though the outcome kind of looks ugly?
Well, the outcome has been great. If you've owned the index and you've owned bonds, you've done great.
But what I'm saying is, if you're not like max growth, right? Like, let's say you've got a portfolio that's a mix of like growth and value, or you've got some international stocks. And I know we've talked a lot about, people rebalancing away from the U.S., but thus far that trade has not been great, right?
No,
like
it's crushed it this year.
Well,
international stocks have outpaced U.S. by the biggest margin in like a decade.
Well, but if you look at the EU, kind of the reaction to the trade deal, it was kind of negative, and the U.S. market, the valuation is much higher. So anyway, my point is just that, like, are there times when you're going to have good process, bad outcome sort of results in your portfolio by not just sort of maxing everything out? When do you stick with process and not look at the outcome as an investor?
Yeah. Telis, two things. First of all, I love the debate right now. I'd love to have both of you in our asset allocation committee, because those are the types of debates we're having about process, but also about markets. Second, you have to look at outcomes over longer periods of time. and you have to think about whether you have a small edge that you can apply to a lot of different decisions over many time periods. Do you remember when Roger Federer, it's about a year and a half ago, went completely viral on social media from his commencement speech to a group of students? Does that ring a bell? And he tells the students, I have played 1,500 matches in my career, and I have won 80% of the matches. But then he said, guess the percentage of points that I have won. And it's remarkable because it's only 54%. So one of the top tennis players of all time lost close to half the points. But he had a small edge that he could apply very consistently that led to strong outcomes over time. Unless and until you're willing to separate luck from skill and accept losing, sports psychology is about losing and what you do with the loss, not about winning. Unless and until you develop that mindset, it's going to be very difficult to stick to your process in markets.
Well, losing, not something people have done a lot of in the markets lately. Maybe they need a little to teach them some discipline. All right, well, we're going to take a quick break, and when we come back, we're going to have one last question for Sebastian Page.
When you are looking for value in the market right now, where are you looking?
We like international value as an example. If you look at the European banking system, you have positive interest rates, you're out of the zero interest rate period, and you have an environment that is stimulative for growth with increased spending. We think German GDP, debt to GDP, could increase by 20% over the next 10 years. Defense spending, infrastructure. So we like those financials, industrials as well in European value sectors. And that's a position that has done well year to date, but is still quite cheaply valued if you just do a relative value. Now, I just need to add a caveat. This is a tactical trade. We like it for 6 to 12 months. I'm not talking about the end of U.S. exceptionalism. Sure. I'm not talking about the fact that the U.S. mega cap tech companies are actually awesome companies with huge earning power, and we own some of them. But tactically, we like that trade of international value.
Well, just in this room, we've had a debate about what's going on in the market. I'm sure the audience has a ton of their own views, which they should feel free to express in comments and emails and reach out and let us know. But we're going to have to end it for here. Sebastian, it's been great. Thank you so much.
Thank you, Sebastian.
Likewise. Thank you.
Is there a speculative mania underway?
Is there a speculative mania? What other kind of manias are there? Is there a less speculative kind of mania?
Cautious mania?
It's a mania rooted in the fundamentals. I've never heard of that one.